Hey everyone, welcome back to Corporate Dakota, the place where we uncover the hidden stories in corporate filings. Looks like City Office REIT is trying to tidy up its finances, but is it all smooth sailing or are there some rough seas ahead? Stick around to find out. Today we're diving into a very important document from City Office REIT, a report that tells us about some key financial moves they've made. It's called a Form 8K, and it's like a prompt update for investors and anyone interested in knowing what's happening behind the scenes. City Office REIT Inc. is the company we're focusing on. They're in the business of owning and managing office buildings, and as you can imagine, that realm has seen some pretty big changes recently with people working from home more often. Now, this report mainly talks about two big things. First, they've updated their credit agreement, which is basically a fancy way of saying they've changed the terms of their loans and how they borrow money. Second, they've sold off some of their properties. Let's talk about the credit agreement update. It's crucial because it affects how much money the company can borrow and under what conditions. Think of it like this. They have a credit card and they've just adjusted their credit limit and the rules for using it. What's interesting here is that they've specifically checked a box that means they're using this filing partly for soliciting material. This usually hints at some sort of shareholder vote or approval needed for a major event like a merger or a big acquisition. So what did they actually change in their credit agreement? They made a third amendment, which is like adding another chapter to their loan agreement. One of the big moves was reducing the amount they can borrow on their revolving credit facility. This means their available credit line went down to $150 million. Why would they do this? Often reducing your credit line can be a sign that the company is trying to be more conservative with its debt or that it's preparing for a different financial structure. It could also be related to asset sales, which we'll discuss next. They also pledge some of their assets as security for these loans. This means if they can't repay the debt, the lenders can take those specific assets. It's a way to make the loan more secure for the banks. They also got rid of references to a 3-year loan that they've already paid off. This is good because it means less debt to worry about, and it was likely paid off using money from the property sales. Now let's get to the property sales. This is where things get really interesting. On August 15, they sold 6 of their 7 office buildings in Phoenix, Arizona for a whopping $266 million. This is a significant amount of money, and selling off properties like this can dramatically change a company's financial picture. The sale included properties like Block 23 and Papago Tech, which are likely well-known office locations in the Phoenix area. They still have one more property in Phoenix called Pima Center, which is under contract to be sold for another $30 million. This sale is expected to happen later, but it's subject to some approvals related to the land the building sits on. This influx of cash from selling these properties is likely what allowed them to pay off that term loan we mentioned earlier. Selling off assets to pay down debt and adjust credit lines is a common strategy, especially in industries facing headwinds like office real estate. As if that wasn't enough, the company also issued a press release on August 15th to announce these sales. News like this is critical for investors to stay in the loop. But here's where it gets even more intriguing. The report also touches on something called a proposed acquisition. It says City Office REIT might be acquired by MCME Corel Holdings LP. This is a big deal. It means someone might be looking to buy the whole company. When a company is being acquired, shareholders usually get to vote on the deal. The company is telling its investors to pay close attention to the upcoming proxy statements, which will have all the details about this potential merger. This is why they checked that box about soliciting material earlier. This section talks about who might be influencing the vote on this proposed merger. It mentions directors, executives, and employees. Essentially, anyone who has a vested interest in the company's success and might be promoting the deal. Now, like most corporate filings, this report contains forward-looking statements. This is a standard disclaimer. They're basically saying, hey, we're making educated guesses about the future, but things might not turn out exactly as we predict. They're talking about things like whether the merger will actually happen or if that last Phoenix property sale will go through. They're being upfront that future results could be different from what they're expecting due to various risks and uncertainties. Some of the big risks they mention include anything that could cause the merger deal to fall apart or problems with the Pima Center property sale. Changes in the economy or even how people feel about office spaces now can also affect their business. They also state they're not obligated to update these future predictions if new information comes out, unless the law requires them to. This is pretty standard, but it means you can't assume they'll automatically tell you if their outlook changes drastically. This last section lists all the supporting documents for the report. It includes the actual amendment to their credit agreement, which is Exhibit 10. This is the legal document detailing the changes. Then there are the pro forma financial statements labeled as Exhibit 99.1. Pro forma means these are adjusted financial statements that show what the company's finances would have looked like if certain events like the property sales had already happened. It gives you a clear picture of the company's underlying financial health after these big transactions. These pro forma statements will show us the combined financial picture after the 6 Phoenix properties were sold. This is where we can see the immediate impact of those sales on their assets and potentially their debt levels. They also provide a pro forma statement of operations for the first half of 2025. This tells us how the company would have performed financially in terms of revenue and expenses if the sales had occurred earlier. Exhibit 99.2 is that press release we mentioned announcing the big sale of the Phoenix properties. And Exhibit 104 is the interactive data file, which is usually for the SEC's electronic filing system. Now let's look at the bigger picture here. City Office REIT is clearly in a period of significant change. They've sold off a substantial portion of their assets in Phoenix, bringing in a good amount of cash. This cash was used to pay down some debt as indicated by the changes to their credit agreement, including the reduced credit line. This suggests a move towards a more conservative financial approach or perhaps a strategic shift. The fact that they're also potentially being acquired is the most exciting development. This could mean a number of things. For shareholders, an acquisition can often mean getting a premium price for their shares. For the company, it might signal that their current path as an independent entity is less attractive than being part of a larger organization. The office real estate market, as we know, has been tough. Vacancy rates have been a concern, and companies are reevaluating their office needs. Selling assets and potentially being acquired can be a response to these industry challenges. The risks they highlight, like the deal falling through or issues with the pending property sale, are very real. A failed merger can create uncertainty and negatively impact a company's stock price. Also, the fact that they're seeking shareholder approval means the deal isn't a done deal yet. We need to see what the final terms of the merger will be and if shareholders will approve it. It's a high-stakes situation for City Office REIT. In my opinion, City Office REIT is making some strategic moves to adapt to a challenging market. Selling assets to strengthen their balance sheet and becoming a potential acquisition target are logical steps when facing industry headwinds and shifting demand for office spaces. The key for investors is to watch the details of the potential merger. If the acquisition goes through at a good price, it could be a positive outcome for current shareholders. However, the risks associated with such a transaction are always present, and the company's ability to navigate these complexities will determine its ultimate success. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.